My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey, welcome back to another great episode. Today, our special guest, zooming in from beautiful Alabama, is a very accomplished real estate entrepreneur with a ton of experience and background in finance. And he's doing something different that I really wasn't familiar with before he booked in this call, and that is flex industrial real estate. So, Mr. Jeremy Friedman, welcome to the show. Great to have you.
Hey, it's great to be here. Thank you for having me.
Okay, well, first things first, let's just kind of unwrap and unravel what is flex industrial real estate. What does that mean? What does that look like?
That is it, right? So we call it the mullet of commercial real estate. So
you are from Alabama, aren't you?
I am, exactly. So it's business up front. Oftentimes it's showroom, office, storefront, and it's roll-up doors and dock highs in the back, warehouse in the back. So if you think about maybe you know it by shallow bay industrial, or maybe you know it by the name, just office warehouse. So most of these complexes are somewhere between 50 and 150,000 square feet, and they're demisable down into, say, 2,500 to 5,000 square foot suites.
Units.
Most every suite typically has some amount of office and some amount of warehouse. So
very cool. So give me an idea of who would be the typical owners or tenants of these kind of properties. And are you building these from the ground up? Are you purchasing existing ones? Are you holding on to them as the owner, landlord, or are you selling them off? How does that kind of work?
Yeah, so the typical tenant in these properties is a service-based company, say HVAC contractors, engineering firms, Terminex.
Carpet cleaner type businesses, like a carpet cleaner type business type thing is.
Exactly. So, they need some amount of warehouse to store materials, supplies, equipment, and then they need some amount of office for, the building staff and meeting in the mornings and things like that, right? So we do have a fair amount of last mile logistics companies, of FedEx and JB Hunt, final mile people, and we have some life sciences. We have several pharmacies in some of our facilities, so like mail order pharmacies and some compounding pharmacies. So it's kind of a little bit very flexible, as you might guess.
The name Flex Industrial, yeah.
Yep. And the interesting thing about Flex and what drew us to it as being a really great real estate investment is the supply and demand imbalance in Flex. And so what I mean by that is, for the last 3 decades, there's not been much new supply brought to market. And that contrasts very differently from any other asset class that I'm aware of. If you think about all of the new multifamily, all of the new self-storage, all the new retail that has come online in the last decade, much less last 20, 30 years, it's very different. And there's a lot of demand as population continues to grow. There's more service-based companies that need to be there. So the reason a lot of new supply has not come along is that, based on what construction costs are and what rents are, it's very hard to make new development numbers work. And so to make the returns work for new development. So what we currently, our thesis is to be able to go in and buy below replacement cost. So we're buying anywhere from, say, $60 a square foot to 110. I mean, our average in our portfolio total invested is somewhere around $92 a square foot right now.
Okay.
You cannot build it for that. And the reason that we can buy it there is because there's some value add lift needed, but rents are $8 to $12 a square foot, and it just new construction at $140 to $160 a square foot new construction costs. You would need $14 to $18 a square foot rents, and they're just not there. So to answer your question, no, we are buying value add multi-tenant flex all around the Southeast. However, I'm going to talk out the other side of my mouth for a second.
Okay.
We do believe that in some markets, the conditions are right now because there's so much demand. The conditions are right to develop this product and be able to bring some new product to market at a higher rental rate. We feel like that protects us in our legacy assets for to have some rent appreciation on the assets we currently own. But we are also looking at a development program that we think we're kind of right there at this moment, getting to where it'll work. So.
Okay, very, very cool. So supply and demand is definitely in your favor, except that in a lot of places it's going to cost too much to build these out to be able to get the kind of rents that you need, but certain areas you can. Two questions I've got. So first is, if these are so in demand, who's selling them and why are they selling these complexes in the first place? And then I'll ask the second question.
Okay, well, great question. Typically, who we're buying from are legacy owners that have owned assets for 10, 20 years in a lot of cases. And this is important because of a couple of things. One, they have not kept up a lot of times with maintenance, so there's some deferred maintenance piece to it. A lot of times they are very hesitant to do any tenant improvements to help gain new tenants. And so sometimes there's some vacancy in there that should not be there if they were willing to work better with the tenants. And then third, there's a high percentage of office build out in a lot of these older facilities. And if you think back to, say, the early 2000s, office was in demand, office commanded higher rents, and that is still stuck in a lot of these owners' minds. They still have some sunk cost in those office build outs, but that's not what the market currently, the rental market is looking for. So we underwrite, when we acquire the property, we underwrite and hold reserves to do all of the deferred maintenance, and sometimes it can be more than just some simple stuff. It's a lot of asphalt resealing and striping and things like that, but sometimes it is roof replacement and things like that. So we underwrite those monies up front. We underwrite leasing commissions and tenant improvement allowances up front and reserve a lot of that. And that's important because tenants come along, and part of it we reserve for ripping out a lot of the office build out and bringing it back to somewhere more in line with the current market demand of 20% to 50% office. Whereas a lot of, when we'll go in and we'll find units that are 80, 90% office, and that's just not what the market wants. We'll go in, rip it out, bring it back to warehouse, and they lease up pretty quick.
Cool. So were they kind of more in line when they're initially built? So they already have the warehouse part in it. They just took over a bunch of the warehouse and built more office space in there, or do you have to punch a hole in the back of the building and create the warehouse space?
No, you're right in the first scenario.
Okay.
A lot of it was more office, more warehouse to begin with, and now it's more officey. As time went on, there was a lot of build out done.
All right, let me see if I caught everything there. So, in summary, you're typically buying these from legacy owners, aka mom and pop owners. Would that be a fair
Yes,
assessment?
yes,
And
and
they're
they're using the cash flow to a lot of times to live off of, and so
yeah.
they're very hesitant to take that cash flow and reinvest it
So
back.
they're not much different than mom and pop apartment building owners, right?
Exactly.
They might be hesitant to put improvements in there. They're not keeping up the buildings to the optimal degree. They're trying to suck all the cash flow they can out of the properties. They've owned them for a long time, so they have little to no mortgage left on those properties. They way overbuilt for office space back in the day when that was in demand, and haven't clued in that that's not as much in demand today. So they got vacancies. Yeah, so you're able to go in there. That's how you're able to add value to these properties, is bringing them up to snuff. Tearing out some of that excess office space if it's not needed, converting back to warehouse space, and then making it pretty for new tenants and renting it out at current market rents. Is that fair to say?
Very fair to say. And
All
so
right.
and you made an interesting correlation there with value add multifamily. It's a very similar situation, only instead of carpet, granite countertops, and paint, and appliances that multifamily people are doing, we have just a different set of of value add or renovations that we're doing. It's more, it's certainly it's
Yeah.
more officey and things like that. So.
So,
It's
Jeremy, I
it's
think
very
you've got a
similar.
lot of previous experience in other asset classes like uh, self storage facilities. I'm not sure, multifamily properties in the past as well. Not all
No,
multi.
no experience in multifamily,
Okay.
really. So
Well,
self storage and
compare and
retail.
contrast this, the flex industrial strategy versus some of the other things that you've done in the past, and why you prefer this more at this time.
So yes, we Stoic. We started our first four assets for self storage, and there's a lot of similarities that we like with flex industrial, such as uh, multiple tenancy. We think that helps vacancy risk. And then shorter term leases. So, it's not 30 days like self storage, but we're dealing with oftentimes 3 year leases, 1 year, 3 year, 5 year on the outside leases. And so that allows us time to reprice rents. And it also allows us, when we acquire the property, to roll over new tenants and bring them up to market,
Mm,
or renew existing tenants if the WALT or weighted average lease term is 1.5 years. We get to reprice that. That helps
right.
us with our value add strategy.
Mm,
Um, and then, but the flip side of that is self storage. The supply and demand imbalance is absolutely the opposite. In other words,
there's a glut.
supply has been increasing dramatically in a lot of cases over the last decade. Really, after the Great Recession, uh, people saw how well it did. Institutional money started flowing in, huge development surge, lots of supply coming online, and then you had higher interest rates kind of put a slowdown in the residential
Yeah.
home selling market, so people weren't moving around as much. So demand dropped, supply's up. It's a tough market right now.
Mm,
Um, Other than that, my other experience is in single tenant net lease retail. And again, that's single tenant. And then you've got long term, typically very flat leases. So
mm,
5 years between rent bumps. We're doing annual rent increases with flex. So usually in the 3 to 4% a year annual rent increases. So
yes.
we're, that and the fact that the leases turn over often enough to be able to reprice. We feel like inflation has set in for long term, not the same rate, not at the same pace we saw 2 years ago, but certainly above the 2 or 3% that is the target. We feel like inflation is set in for long term, and we like an asset we can reprice rents a little more quickly. So,
Yeah.
so
Plus,
those are.
it's a longer term. It's a lease. It's not a month to month rental type thing with residential
Mhm. Yeah,
stuff.
yeah.
You're dealing with a professional person as a client versus a regular tenant, right? With a single family home. You were talking about a glut of self storage facilities. I saw that firsthand, Jeremy. My wife and I just recently took a little trip down to Washington State, and we took the
Okay.
scenic route and drove through basically the middle of nowhere. And I couldn't believe how many self storage facilities there were in the middle of nowhere. And I was thinking, who the heck is renting all of these self storage facilities? It doesn't seem to be the population to deal with this in these out of the way places. So yeah, that makes, I think everybody got on that bandwagon, and now there's that glut. There's going to be that correction. Cool.
And we feel like flex industrial is probably along that same trajectory at some point.
Yeah.
We do feel like it's performing well. It's getting more attention nowadays. We do think there'll be more cash, more capital inflows into that asset class, and therefore there will probably be a development boom. Um, so we think it's the right time to be acquiring,
Yeah, you're
stabilizing.
the early adopters, right?
Well, maybe not as early as I hoped, but yes.
Earlier. Makes
Earlier,
sense.
okay.
So Jeremy, a big part of your business is raising capital to acquire more properties. You know, a lot of our viewers and listeners are kind of thinking about doing that themselves for some of their deals. So what do you find? I think you've started your own fund or funds. What do you find these days is working well for you guys for generating interest in investors? What works best for you?
So, so we began by syndicating assets, and raising anywhere in single assets. We syndicated, and we were raising anywhere from say $1.5 million to $3 million in equity for those assets.
Mm-hmm.
We completed 10 assets that way, and then we moved to, as you alluded to, a fund model. We had launched a fund that we launched towards the end of last year. We are currently raising and deploying those funds until the end of this year, November of 24. And it's been interesting where, our target is $25 million in equity. Currently, the fund has 3 assets, so now we're total of 13 assets total at this point in time. The fund model is an interesting model. It has allowed us to, the problem we had, which was admittedly a very good problem to have, is when syndicating, we would try to increase our investor base, but we had no product to sell them at the moment, no active live deals. And then we would launch a deal and send it out there, and the same few people would jump in and take all of that investment. And so it became very hard to grow our database of investors. So what the fund has allowed us to do is to grow our database of investors. And we're still working the kinks out. One problem we have is once people are invested in a fund, they don't necessarily want to continue to invest in the same fund. They'll invest in the next fund or invest in
Or
another
the next
syndication.
deal. Yeah.
Yeah, or the next deal. So that's been a little challenging to understand that dynamic. And we're starting to get to the size where we're seeing some larger check writers are interested in what we're doing versus more of the retail check writers. And so balancing that, it's very much a work in progress.
Yeah.
But,
Very a lot
it's a lot.
involved with starting your own fund. I haven't done it before, but just I've interviewed a number of people, a lot of the same kind of issues. One gentleman I was interviewing the other day does a combination. So he's got the fund typically for the smaller amounts and the people that are, what have you. And then for the deeper pockets people that want to be involved in one specific deal, they still do syndications. So they got some assets in the fund and they got other assets in syndication. I'm not sure if there's some combination of the two, but they kind of serve different needs that way. So
Yeah, so we have very similarly probably to the structure they're doing is we raise money into the fund, but we do have some larger check writers that want to be in a single asset, and so the larger check writers will joint venture with us at the asset level alongside with the fund. So they'll all be common equity, but the fund will have multiple deals that it's distributed out, and then the single check writers are in the step one asset. So
okay, so kind of a
sounds very
combination of
similar.
both, best of both worlds, theoretically.
That's what I think where our natural evolution is taking us right now.
Yeah,
So
very
sounds
cool.
similar.
Well, yeah, so when it comes to finding new check writers, what do you guys find that's working well for you for generating investor leads these days? New investor
Um,
leads. Yeah.
so we've tried some paid advertising on social media, and while it generated a lot of leads, it did not. Those leads, not many of them converted to actual investors. What we have found is that networking with our existing investors to network with their peer groups,
Referrals
um,
type thing. Yeah.
and then just actual uh, kind of our own content that we're putting out, people find it and will come to us. And that's unpaid content that we will put out.
Organic material that you're putting out there.
Organic, yeah.
Yeah, very smart. As in any business, nothing beats referrals, that's for sure. So you've got
That's right.
your current investors vouching for you to their friends and family members who also tend to be well heeled. So that skips that whole relationship building process because you're piggybacking on the relationship they already have with the other person. And it's just a massive shortcut. But I'm glad to hear that your your organic content is generating leads as well. Is that primarily through like blog articles or video stuff or social media posting or all of the above?
So blogs, going on podcasts such as this
Yeah.
one,
Yeah.
and then our team helping promote that through social, and we're pretty active on LinkedIn, Facebook, believe it or not, so we do have some blogs that we're doing, on our website that then we'll post. Our newsletter tends to get more readership than I believed it would. It's been very successful, and we'll have people share it with their friends. And so, it's kind of a combination of all of the above.
Very cool. Well, Jeremy, thank you very much for being on the show and sharing your insights into this flex industrial real estate asset that I didn't have much of a clue about before. Now I do. Now I understand it. And congratulations on the success with that. If some of our viewers or listeners would like to find out more about you and what you're up to, where can they go?
Probably the quickest and easiest route would be through our website, which is stoicep.com. So Stoic, STOIC, EP, which stands for Equity Partners.com.
Good.
My email and phone number is there. My partner, Grant Reeves, his phone number, email is there. All the links to all of our social channels are there. So it's probably the best central place to find us. And I love talking about real estate. I'm just a big real estate nerd. So anybody's welcome.
You're in the
to
right
reach out
place.
anytime.
That's
Yep.
great. Awesome, Jeremy. Well, thank you very much. And everybody, thank you for tuning in, and we will see you on the next episode. Take care. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.